Hey, very good morning to you traders. Mark here from the Day Trading Room, Path to Pro series, short video ideas to help you move from losing trader status into making some money. Today I want to talk about stops. Yes, I know in a 5-minute video can I talk about stops, but I want to say is that I think the majority of people have stops that are too tight. I'm going to say it because I think that's the case. Some of my stops, some of my setups are you do use tight stops, but they are setups that are based on a specific tape pattern. It may be unfamiliar to you, but the guys who've done the program are going to know about this. If I talk about an institutional iceberg sitting on the bid or on the offer, the price is pushed up, it comes back down, we see the institutional order reloading, I will take a trade then with a stop behind him. That is a very tight stop because that is based on the premise of the trade is that that guy that I've seen on the tape soaking up those sells is going to hold, and the price is going to naturally reflect off him, and he's then going to push up and take offers and help the price move up. So that is the fundamental reason for the trade. So if he disappears, the fundamental reason for the trade is gone. I'm taking a stop. That is why it's a tight stop. A lot of people though are using tight stops when they're fading key levels. So the price is coming down to, a whole number like 9,400 on the DAX or whatever. They're using a 10 tick stop, a 10 point stop or whatever it may be, and it's just blasting through it because there's no reason why you should be using a stop like that. People don't stand at massive levels and just sit there. You think about, I know these analogies, you hear about these all the time, but if you think about when you're stopping, a car's rolling towards you and you're trying to stop it, unless you're a ridiculously strong guy, you're not going to be able to just stop it dead. You're going to have to, if it's rolling towards you, you're going to have to just slowly stop the thing, and then eventually, you might be able to just push it back, because it's a heavy thing, it's rolling, it's got momentum. But the more people obviously that are standing there helping you, the less likely it is to overshoot, and the more likely it's going to accelerate going the other way. But the less people, we've got one guy only, then it's going to take you a long time to stop it before it starts moving the other way. It's the same with the markets. So if you're selling at a resistance level or buying at a support level, you're going to have to use a reasonably wide stop to take the trade. Or if you're not comfortable with using a wider stop to take the trade, why not look for a second test or something in addition to that key level? Now, what do I mean by that? I mean that once a level has defined itself as being important, look then for a second test or a wick, something that gives you an additional criteria that the trade is not valid if that's gone. So I've just got the DAX up here intraday. Let's say you think that you want to sell a pullback on a push up here. And why would you sell it here? Okay, that is the turning point at that point in time, but it means nothing. But then if you look and you see a second test here that wicks, maybe you've created a scalping opportunity. Maybe then you can quantify your stop. I am always looking for setups that have a realistic and quantifiable risk. Okay, if I have to take a trade that is at a key level and I haven't really got a quantifiable risk there, then I'm going to have to use a large stop, and that's going to have to be a decent percentage of the daily ATR, like it or not. Otherwise I know I'm just going to be throwing money away. The chances of that turning on a sixpence and just reversing and giving me a nice 10 tick stop is slim. So I'm either going to take that trade at a key level because it's a good level on a higher time frame, and I'm going to have to use a wider stop, I'm going to have to reduce my position size to suit, or I'm going to add an extra layer of edge into the trade which gives me a quantifiable risk. That could be a wick, that could be a second test, that could be just something that indicates that that level is true, and it's something I can put my stop behind and say, okay, the level is there, we've retested it, now I know that if we break it, the premise of the trade is not valid, so I can afford to put my stop just underneath it. Example might be if you're buying this support level here, you can say, okay, it's held, if we break under it by 10 ticks now, we've had 2 tests, then it's fair, rather than just touching it one time, if that makes sense. So I'm not just looking for a one touch of a trade, or even that's the same when we have the traditional opening drive type trade. We talk about that a lot. Opening drive type trade, we're pulling back. How far is that going to pull back? You know, ultimately the buyers could back right off. We could pull back here heavily before spiking straight up. So if you're buying just a little tiny pullback here, you're going to get stopped on. Fundamentally is a good trade. But if you get this and you get some sort of flagging action and a test that underneath that fails and then pushes back up, there's your quantifiable risk. You know, so I'm always looking for something to quantify that stop on a second level, rather than just an initial premise, initial idea of selling resistance, buying support, buying a pullback. I'm looking for a further variable that I can add into it that says, you know what, this allows me to tighten that stop up, it allows me to limit the risk, and it means that if this goes, the trade is definitely not on, the trade is definitely not working. So worth bearing in mind. Manage the risk, guys. Good trading. Back with another one of these videos soon. Take care.